Imagine investing a mere $1,000 in a company and years later witnessing that investment soar to over $21 million. It might sound too good to be true, but this is precisely what unfolded when Warren Buffett assumed control of Berkshire Hathaway. Even amidst recent market downturns, the returns remain remarkably impressive. Warren Buffett is rightfully hailed as one of history's greatest investors due to his consistent outperformance of the market, amassing a personal fortune worth billions. So, what's the secret to his success? Today, we embark on a deep exploration of Warren Buffett's mindset, unveiling the 6 principles guiding his investment approach. These principles have been instrumental in crafting one of the most prosperous investment portfolios in history. By the end of this video, you'll gain valuable insights on how to invest with the acumen of Warren Buffett. Rule 1. Cash is never a good investment. Warren Buffett's first investing rule is clear and direct. Cash is never a good investment. According to Buffett, cash doesn't generate returns, making it an unproductive place for your money. Instead, he advises investing in assets with cash flow potential or appreciation. While cash serves as an emergency safety net, Buffett emphasizes having only enough cash to cover immediate needs, discouraging excessive cash holdings. Consider this. $100,000 in cash may seem substantial, but with inflation, its real value diminishes annually. In contrast, investing in a productive asset like a rental property provides a steady cash flow and potential appreciation. Buffett, known for disliking cash, prioritizes owning good businesses over holding cash. He monitors his cash balance closely, ensuring it meets his needs without accumulating excess. In his own words, "I would much rather own a good business than cash." Rule 2. Invest in productive assets. Warren Buffett's second investing rule is clear: invest in productive assets. These are assets that generate value, like a farm producing crops, a rental property yielding rent, or a profitable business. Buffett and Charlie Munger advocate for these assets, emphasizing their potential for cash flow and appreciation. Consider a farm. Its value lies not just in land ownership, but in expected annual crop production. Similarly, a rental property is an investment for a reliable stream of rental income. Productive assets not only offer income but also act as an inflation hedge, increasing in value over time. Buffett's approach is pragmatic. When buying a farm, for example, you gauge its worth based on expected crop yields. This principle aligns with their successful investment careers. As Buffett notes, if you buy a farm, you expect to get a certain amount of corn or soybeans, and you decide how much you pay based on how much you think the asset itself will deliver over time. This focus on productive assets underpins Buffett and Munger's enduring investment success. Rule 3. Be patient. The third rule of investing, according to Warren Buffett, is to be patient. He believes that good investments take time to pay off, and that investors should be prepared to hold on to their investments for the long term. This approach is in stark contrast to those who try to time the market and make quick trades based on short-term fluctuations. Buffett is known for his long-term investment horizon. He once said, "If you're not willing to own a stock for 10 years, don't even think about owning it for 10 minutes. Being patient also means not getting swayed by market fluctuations. It's important to remember that the stock market is inherently volatile, and there will be times when the market goes up and times when it goes down. But the key is not to let these fluctuations affect your investment decisions." Buffett is a firm believer in the power of compounding. He once said, "You don't need to be a rocket scientist. Investing is not a game where the guy with the 160 IQ beats the guy with the 130 IQ. Rationality is essential." By being patient and not getting swayed by market fluctuations, investors can take advantage of the power of compounding and reap the rewards of long-term investments. Rule 4. Evaluate assets according to their future production. The fourth rule of investing, according to Warren Buffett, is to value assets based on what they will produce. This principle builds on the previous one, where he emphasized the importance of investing in productive assets. By valuing assets based on their production potential, it allows the investor to make a rational calculation and have a clear expectation of the asset's performance. It's a simple yet powerful concept. Instead of focusing on the past performance of an asset or trying to predict its future performance, the investor should focus on what the asset can produce. For instance, when buying a rental property, the investor should calculate the expected rental income, operating expenses, and potential appreciation to determine the value of the property. This principle is a logical follow-on to the second rule, as it enables the investor to make well-informed decisions based on facts and figures, rather than emotions and speculation. As Buffett said, the success of that investment will be determined in your own mind by whether it meets your expectations as to what it delivers. Rule 5. Only invest in what you understand. The fifth rule of investing, according to Warren Buffett, is to invest in what you understand. He believes that it's important to invest in something that you have a good understanding of, whether it's a specific industry or a specific company. This principle is rooted in the idea that investors should only invest in something that they truly understand. If you don't understand the industry or company, you are more likely to make mistakes and invest in something that may not be a good investment. Buffett is a firm believer in the power of knowledge. He once said, "You should invest in the businesses that you understand. By investing in what you understand, you can make more informed investment decisions and avoid the pitfall of investing in something that you don't truly understand." Rule 6. Avoid over-diversification. The sixth and final rule of investing, according to Warren Buffett, is to avoid over-diversification. He believes that diversifying your portfolio is important, but too much diversification can lead to spreading your investments too thin. Over-diversification can lead to a lack of focus, and it can be difficult to keep track of all your investments. This can make it harder to make informed investment decisions and can lead to suboptimal returns. Buffett is a firm believer in the power of concentration. He once said, "Diversification is a protection against ignorance. It makes little sense if you know what you are doing." By avoiding over-diversification, investors can focus on a smaller number of high-quality investments and increase their chances of achieving long-term success. In conclusion, Warren Buffett's 6 investment principles form a robust basis for constructing a successful portfolio. Adhering to these principles enables investors to make well-informed decisions, enhancing their prospects for long-term success. It's crucial to recognize that investing is a gradual process, requiring patience, time, and a thorough comprehension of both markets and invested companies. Appreciate your time spent watching this video on Warren Buffett's 6 investment rules. We trust it provided valuable insights. If you enjoyed the content, please give it a thumbs up and subscribe for more videos of this nature. Your support empowers us to deliver more valuable content. We eagerly anticipate your presence in our upcoming videos.